is real money. You know, in the Coinage Act of 1792, the dollar was defined as a weight of gold. Gold is money, and in terms of real money, and a lot of people at the Money Show are going to be talking about the bull market in U.S. stocks. The Dow is at 46,000. Well, the bull market is an illusion created by inflation. The U.S. has been in a historic bear market for 26 years. Now you might think, well, Peter, how is it in the bear market? We're at 46,000. In 1999, you needed 45 ounces of gold to buy the Dow. The Dow was at 11,500 or so. That was the peak in 1999. And gold bottomed around $250 an ounce. 255, I think, was the exact bottom. Today, even though the Dow Jones is at 46,000, you only need 11 ounces of gold to buy the Dow. So in terms of real money, in terms of 20 gold pieces, $20 gold pieces, in terms of that money, the Dow has declined by 75% over 26 years. And it's not over. This bear market is going to accelerate. It is accelerating now. By the time it's done, I think you'll be able to buy the Dow Jones for less than 2 ounces of gold. Now, where I'm coming up with 2, and I've had this forecast for quite some time, the last 2 significant bottoms in the U.S. stock market, 1932 and 1980, you could buy the entire Dow Jones for about 1 ounce of gold. And I think we're headed for that type of decline again today. I think the Dow will be cheap at 1 ounce of gold or 2 ounces of gold. I'll be happy to invest at that point. But right now, we have a significant decline because to go from 11 ounces to 2 ounces is about another 80% drop. Year to date, gold is up more than 60%. Just this year, 2025. Silver is up about 85%. Now, the last time gold was up this much in 1 year was in the 1970s. And during the 1970s, there were several years where gold was up more than 60%. It didn't just happen once. I think there might have been four years in the 70s. And it's not a coincidence that something that is happening now hasn't happened since the 1970s. Because the U.S. economy today has a lot in common with the economy we had in the 1970s, except it's a lot worse. Right? The 1970s, people remember for stagflation. We're going to have something a lot worse than stagflation. We're already in it now, but it's going to get much worse. But the significant monetary event from the 1970s started in 1971 when Richard Nixon temporarily closed the gold window and made it so foreign holders of U.S. Federal Reserve notes could no longer exchange them for gold. There was a fixed exchange rate. If you had $35, you could get an ounce of gold. And it was because the dollar was backed by gold and convertible into gold that the dollar was or became the reserve currency through the Bretton Woods system, where foreign central banks backed their currency with dollars. But the dollar was backed by gold, and you could convert your dollars on demand into gold, which was why they said the dollar was as good as gold. In fact, it was better because you can then invest the dollars in treasuries and earn interest on your gold. But during the 1960s, our government, became very profligate, and we started to run these large budget deficits. Now, compared to the ones we run today, they were nothing. But at the time, they were big deficits. And the government was spending money to fight the war in Vietnam, to fight the war on poverty, which we lost. In fact, we lost both those wars. To go to the moon. Right? We had a lot of government spending, and we didn't have enough tax revenue to cover the bills. And so we were printing money. We were creating inflation. We were creating more liabilities for gold than we had gold. And the rest of the world began to get suspicious that we could not make good on our commitments, and we didn't have enough gold to back up the dollars. And so foreign central banks began to bring their dollars back to the US and demand their gold, which initially we honored. But then a lot of gold started to leave the United States. And if we didn't do something, we were going to lose all of our gold, which would have been a disaster. And so Richard Nixon had a choice: either act fiscally responsibly, balance the budget, cut government spending, right, or devalue the dollar. And he initially tried to devalue the dollar. That's why the official gold price is now $42.22. The problem was they didn't devalue it enough. And to spare the country of the embarrassment of a major devaluation, and because they didn't want to cut government spending, they didn't want to raise taxes. I mean, nobody wants to do that now. And they didn't want to do that back in 1971. So Nixon really did the unthinkable. He just said, you know what, we're going to default. We're just going to tell people, you can't have any gold for your dollars, even though that's what the dollar was. It was gold. They had Federal Reserve notes, which were IOUs for dollars. And Nixon said, no, we're not going to give you any gold for your dollars. And it was supposed to be temporary, but it ended up, being pretty much permanent, because it's more than 50 years later and you still can't get any gold for your dollars. And so when that happened, there was a major collapse in the value of the dollar, because the dollar was backed by nothing, and a dollar backed by nothing is not worth the same as a dollar backed by something, by gold. So during the decade of the 1970s, the US dollar, measured against other currencies, like the Deutsche Mark or the Swiss franc or the Japanese yen, the US dollar lost about 2/3 of its value. And because the dollar lost a lot of value, prices went way up. You needed a lot more dollars to buy stuff. That's why you had all the inflation of the 1970s. It was because our money lost value. Oil, which started the decade at $3 a barrel, got up to $40 a barrel. Now, back then, it was popular to blame OPEC, right? They're gouging us, they're jacking up prices. It wasn't OPEC's fault, it was our fault. We screwed OPEC because we used to give them gold for their oil, and then we just gave them paper. Well, if we're going to pay in paper, well, we got to pay a lot more. So they didn't raise the price of oil, we lowered the value of the dollar. So now we needed more dollars to buy oil. But of course, the biggest impact was in the price of gold, which rose from $35 an ounce in the late 1960s to $850 an ounce by 1980. Now, the market eventually stabilized. The dollar stabilized. Gold fell back off to about $400 or $500 because Ronald Reagan came in and we had Paul Volcker, and we allowed interest rates to rise to 20%. And that ultimately broke the back of inflation and restored confidence globally in the US dollar. Now, the US dollar is no longer backed by gold, but it continued to function as the world's reserve currency, despite the fact that it was no longer backed by gold. That opened up an opportunity for us to exploit the dollar's value as a reserve currency, to run even bigger deficits than the ones that we were running in the 1960s. Because we no longer needed any gold. We could create money at will. And then we used that money, we spent that money to buy all kinds of products all around the world that we didn't produce. And we were able to borrow a lot of money that we didn't save, because the whole world was trying to accumulate the money that we printed. Because the US dollar became the substitute for gold as the anchor of the global monetary system. And that enabled the United States economy to change in a very unhealthy and unstable way. We went from a nation of savers and under-consumers to a nation of profligate borrowers and spenders. Our manufacturing infrastructure disintegrated as we began to import more and more of the stuff that we no longer had to produce. After all, why have factories have pollution, have to make all those investments, well, we can just print money. Let China build all the factories, right? Let them make all this stuff. All we got to do is run money off the printing press. And so we developed this consumer-based economy based on spending, based on borrowing. We populated the country with shopping malls as we shut down our factories. And we became completely dependent on the rest of the world. We depend on the world for the goods we consume and for the money we borrow. And another perverse consequence of these massive trade deficits that we've been running for decades is as we borrow money or as we spend money that we print to buy goods that we don't produce, the countries that earn those dollars selling us stuff that we really can't afford, they take those dollars and they buy U.S. bonds. They buy treasuries, they buy mortgage-backed securities, they buy stocks. So our inflation that we create, not only do we export it, but then it comes back into financial assets. So our stock market and our real estate market are much higher, and our interest rates are much lower. So we've been living in this complete bubble economy where we get the benefit of artificially low consumer prices, artificially low interest rates, and an artificially high stock market, all because of this system where the US dollar is the reserve currency, everybody wants it, and we're the only ones that can create it. Now, what I've been warning about at money shows for 20 years is this system is going to come to an end. And that's what's happening right now. Before the 2008 financial crisis, I was coming to the Money Show in 2002 and 2003 and 2004. They would have these bull-bear debates, and I was supposed to bear. And I was warning about the financial crisis. And I was pointing to the housing market and the bubble and the artificial low interest rates. And I was warning about a collapse. In fact, at one point we had a hedge fund. I was trying to get people at the Money Show to invest in my hedge fund to short the subprime market because I knew this whole thing was going to blow up. And I wrote a book about it called Crash Proof: How to Profit from the Coming Economic Collapse, in which I laid out my thesis for why the housing market was going to collapse, why we were going to have a financial crisis. But the real crash that I was worried about was not that one, not the one that we had in 2008, but the one that I expected to follow based on what I knew we were going to do in the aftermath of the financial crisis. See, I knew that we were going to do QE before they even invented the word. I described exactly what we're going to do, and I said the result of all this is going to be a dollar crisis, where gold's going to go through the roof, and you're going to see this big crash in this dollar and the bond market. That hasn't happened yet. It's about to happen. It's probably going to happen next year. This may be the last Money Show where you have a chance to protect yourself. And, when the subprime market blew up in 2007, and I had been waiting for this, I had been warning about it, I understood subprime completely, we were short the market, and when it happened, when it hit, I became, okay, now what I've been warning about for 4 or 5 years, it's going to happen. The financial crisis is coming, the banks are going to fail, Fannie and Freddie are going to go bankrupt. I knew this whole thing was going to implode. But the mainstream financial world, Federal Reserve, Fed Chair Ben Bernanke, they all just downplayed it. They said it's no big deal, subprime is contained, don't worry about it. And I was alone on every financial network that no longer has me on. But I was on Bloomberg every week, I was on CNBC every week, I was on Fox, I was on CNN, I was on MSNBC, and I was warning about this financial crisis that was coming. Because I knew that once subprime collapsed, I knew what that meant, because I understood the problem. But the people that didn't understand the problem dismissed the warning. And of course, in 2008, we had the crisis that I knew was coming. But when we got the subprime collapse, that was the trigger that said, aha, Peter, it's finally here. Right? Now it's close. Well, what's happening with gold right now, right? This is the first warning sign that the system is about to topple. What has been happening for the last several years is all these central banks that have been using dollars as the reserve for their currency, are divesting of dollars. The days of the dollar being the primary reserve currency are rapidly coming to an end. That is what gold is telling you. All right, we got 5 minutes. A lot of the exodus started under Biden with the sanctions against Russia after they invaded the Ukraine. That sent a warning that anybody can be next, that we can pull the rug out from you. If you put your trust in dollars, we can screw you if we don't like what you're doing. And so that was a wake-up call. But then, I think what's really accelerated the trend, the budget deficits exploded under Biden. It started under Trump, right, with COVID. 2020 is when the reckless money printing and budget deficits just really started. And so the inflation that really began under Trump surfaced under Biden in a big way, right, in 2021. And the budget deficits exploded. And the world got nervous. But the Republicans, at least when they campaigned, they said, look, we're going to cut government spending, we're going to balance the budget, we're going to have Doge, we're going to have all these cuts, we're going to get our fiscal house in order. But then, when the Republicans got in office, and Trump embraced the big, beautiful bill, which not only preserved all the excess spending under Biden, but made it much worse. And then, when Donald Trump launched all these tariffs, vilifying all of our trading partners, Donald Trump, of course, has the whole relationship wrong. The world hasn't been taking advantage of us. We've been taking advantage of the world. We've been giving them paper for all their stuff. We've been living off them. We've had an artificially high standard of living because the rest of the world subsidizes it and makes it possible. So we bit all the hands that have been feeding us, and then we destroyed what was left of the pretense of Fed credibility by demanding that the Fed cut rates, Trump calls Powell an idiot, a moron. Look, I got no respect for the Fed either. But when you're starting to bash them in front of the world, and you're putting your cronies and you're stacking the Fed like Roosevelt stacked the Supreme Court, you're making our creditors extremely nervous. Trump wants interest rates slashed. He wants the money printers going. Interest rates are too low. The Fed never should have cut rates. They never should have stopped hiking rates. The fact that gold is at 4,260 right now is proof that interest rates are too low. Inflation is way above the 2% target and headed in the other direction. Yet the Fed is cutting rates. Why are they cutting rates? Because we're broke. We have so much debt that if we let interest rates go up, we can't afford to pay. So the alternative is massive inflation, and the world knows that. So the world is getting rid of their dollars. And this means the America's ride on the global gravy train is coming to an end. It has profound implications, not just for investors, but for every American whose standard of living is going to be irreparably lower as a result of this. Consumer prices in America are going to surge like we've never seen, much more than the 1970s, and long-term interest rates are going to soar. Now the problem is, the government, the Fed, is going to try to stop interest rates from going up. How do they do that? They got to print money to buy all the bonds that the rest of the world wants to sell. But that means that they create even more inflation, and we run the risk of hyperinflation and a complete destruction of the US dollar. And the only way to prevent hyperinflation is to allow interest rates to rise the way they did in 1980, maybe 20%, maybe more. But when that happens, the whole debt-fueled economy has to implode. All of the major banks have to fail. All the too big to fail banks that we bailed out in 2008 are much bigger. And the next time they fail, there's no bailout, because we're not going to have a financial crisis. We're about to have a currency and a sovereign debt crisis. It's not that people are losing faith in the ability of a subprime mortgage borrower. They're losing confidence in the United States, in its ability to pay its bills legitimately without creating inflation. So when the epicenter of the crisis is the U.S. Treasury market and the U.S. dollar, the U.S. government is helpless to bail anybody out, right? So the losses are going to be spectacular. Most Americans, unfortunately, are going to be completely wiped out. They're going to see the value of their savings and investments evaporate to next to nothing. And since the government is not going to be able to bail you out, you got to bail yourself out. And you got to act now. right? You can't wait until the dollar collapses to try to preserve your wealth, because then it's gone if you've left it in dollars. And the rate at which gold is going up just tells you that time is running out. I know I got a workshop at 4:30, and I'm going to go over the strategies that we have. I mean, our basic foreign dividend-paying stock fund is up 50% this year, because money is being sucked out of the U.S., and this is the very beginning, and it's starting to go home, back to foreign markets. Our gold fund has more than doubled on the year. A lot of gold stocks have tripled, quadrupled, but they're still cheap, despite the fact the segment of the market right now that has the fastest earnings growth, much faster than techs, are precious metals mining companies. Their earnings are skyrocketing, and that is going to continue, and they're so under-owned, hardly anybody owns gold mining stocks, or even gold. And so I have 4:30 is my workshop. We're going to go over specifically the funds that I manage, the separately managed accounts, the things that you can do now to protect yourself. And between now and 4:30, when I'm finished with this, go to my website at schiffgold.com and buy some gold and silver now. Don't wait till later today, because it'll be more expensive by then. Right? Your dollars are losing value. At the rate gold is rising, it'll be over 5,000 by Thanksgiving and over 6,000 by Christmas. Right? These are not normal times, and it's not gold that's going up. It's the value of your money that's going down. But the next thing you're going to see is a crash in the dollar on the foreign exchange markets and a crash in the bond market, meaning interest rates are about to soar. Nobody is prepared for that outcome, but that's exactly what's going to happen. Oh, and by the way, Bitcoin's going to crash too. And it's crashing right now. It's in a major bear market. Bitcoin is down almost 30% if you price it in gold since August. Right? The Bitcoiners don't even realize how much money they're about to lose. They've already lost a lot and they're in denial. But anyway, I know I got to take some questions, so who's got one? Yeah. What do you think I'm talking about? Yeah, de-dollarization. That's what's happening. Yeah, look, I think gold's going to be at least $20,000 an ounce. You know, years ago, I used to say $5,000 gold, but the problem is we've printed so much money since then that, you know, it's a moving target where it's going to be. But in order for the U.S. to go back on the gold standard, or even close, gold would have to be a lot higher than that. But I think the world is going back on a gold standard. That's what's happening. You know, a lot of people have said, or taken the dollar's position for granted, because they said, oh, the dollar's always going to be the reserve currency, because there's no other currencies that can take its place. You know, who's going to trust the euro? Who's going to trust the pound or the yen? And I always said, no currency has to replace the dollar. The world just goes back to gold. Gold was always the anchor of the global monetary system. Gold is the money. The paper is just a credit. And that is what central banks are doing. They are replacing their dollars with gold. And this is just getting started. And now private investors, for the first time, are buying gold. Morgan Stanley just said that the 60-40 portfolio should be 60-20-20. You should sell half your bonds and buy gold. Right? This is the beginning of the trend, not the end of the trend. It is de-dollarization. But the problem is, now Americans, we're going to have to produce. If we want to consume, we got to produce. If we want to borrow, we got to save. We don't do those things. Right? I mean, Donald Trump has been attacking the symptoms of the disease while making the disease worse. Right? Tariffs aren't going to work. Right? All they do is make what's left of our manufacturing even less competitive. But this is a major economic event. It's not just financial. The whole American way of life is going to change.
Okay, two quick questions, and then as a reminder, everybody, Peter will be speaking in the Royal Dublin room at 4:20 if you don't get a chance to ask. Or 4:35 if you have.
I can't really see the hands.
Okay,
Hey, Peter.
for someone who's already invested in gold and silver, the metals, and the miners, if they wanted to invest more, do you think they should go with the miners or metal?
Well, look, everybody should have some physical metal, but in your case, you already have some. Look, I did a special report in April of this year, the best way to buy gold. And I said, don't even buy physical gold, buy the mining stocks, because they were so cheap. I mean, I couldn't believe how cheap they were. I bought more myself, because gold was over 3,000, and these mining stocks were lower than they were, when gold was almost 2,000 a year earlier. In fact, we had, from our gold fund, we had record withdrawals. After Donald Trump won, fourth quarter of last year and the first quarter of this year, a lot of people sold their gold stocks. One of the dumbest things they could have possibly done. But they got fooled into thinking that Trump was actually going to do something that was going to be good for the economy. And I kept saying, he's just going to run bigger deficits than he ran before. It's money printing. It's massive inflation. That's his entire economic plan, is to create inflation. So I still think that gold stocks are a great buy, especially some of the smaller companies. That's why I love my gold fund, the Euro Pacific Gold Fund, which you can buy at any discount broker, no load, EPGIX. The reason we've underperformed the GDX or GDXJ, that are maybe up 140% this year, and maybe we're up 110 or 115%. The reason we're not up as much is because a third of our portfolio is in these really small exploration companies that I think are going to be the superstars of 2026. So I think we're going to way outperform. So my fund, I think, is a great buy because you still get the bigger companies and the royalty companies, but we put together a phenomenal portfolio of these junior miners that you really couldn't even buy. It'd be hard to even buy all those stocks now because there's not enough liquidity in the names. But when the money eventually goes down, to this part of the market, I think it's going to explode. So you still have a lot of opportunity. I think gold stocks, are 5 to 10x from here at a minimum, from where they are now, not from where they started.
One last question over here.
Yes, Peter. Everybody talks about inflation, but not too many people speak about the speed of the inflation. I'm from Venezuela, so I understand hyperinflation really well. And a lot of people look for equities as a rescue, but the problem with inflation and the speed, if you look for equities under hyperinflation, if the speed of inflation is higher than the growth, you're gonna be worthless. You're not gonna have defense. So what are your thoughts about that?
Yeah, first of all, the pilot who flew us over here is from Venezuela, so we were having a chat about it on the plane. And it's unfortunate, because Caracas was a beautiful city, and it's not that far from where I live in Puerto Rico. I would have liked to have spent some time down there if Chavez and the socialists didn't root it. But yes, hyperinflation destroyed Venezuela, but it was the politicians that created it. But all inflations are created by government. By definition, inflation is an expansion of the money supply. That's what it means. Rising prices are simply a consequence of inflation, but the main reason that governments try to redefine inflation is because they don't want the public to know that they're the source. Inflation is a tax that the government levies on the populace when it doesn't want to collect legitimate taxes. So it prints money, it spends it into circulation, and then prices go up. And when it turns into hyperinflation, which it could happen in the United States, because the only way to stop it is to raise interest rates significantly above the rate of inflation. But given the fact that we have so much short-term debt right now, we can't kill inflation without destroying the whole economy in the process. Now, it's worth it. I think we should do that, but the politicians won't do that. So they might destroy the currency instead, which has even worse consequences than allowing the credit collapse and all the defaults and all the bankruptcies that would result. But yeah, the worst thing you can own in hyperinflation are bonds, right? So you shouldn't own any U.S. bonds, whether they're treasuries, mortgages, corporate bonds, none. You should be completely out. You're going to get destroyed if you own bonds. You want to own equities. But in hyperinflation, the equities that don't do well are high PE growth stocks. You want to have value companies that can pay dividends now and that have pricing power. They can raise their prices and raise their dividends because there is a premium on earnings today when you have high inflation, not earnings out in the distant future. So most Americans are loaded up on high growth tech stocks. These stocks are going to come down in a high inflation, stagflation, recession, depression type environment that we're heading into. The best thing you can do is invest out of the dollar completely. Buy foreign stocks, get into the emerging markets. In fact, the world is going to experience an economic boom. When Donald Trump announced Liberation Day, it really was Liberation Day for the rest of the world. They were going to be liberated from the burden of having to support the United States economy. So when the dollar collapses and all these other currencies go up, that means the rest of the world can now afford to buy what right now is too expensive. All that stuff is going to be too expensive for Americans, but now other people will be able to afford what Americans can't. So the world is going to see an economic boom as the U.S. sees a bust. And where the boom is going to be most pronounced is in the countries that have borne a heavier share of the burden. And those are the BRIC countries, the emerging markets. They're the ones that have been doing all the heavy lifting. They've been doing all the saving, they've been doing all the producing, and now they're going to finally enjoy the fruits of their frugality and their hard work and their labor, and we're going to have to suffer. I mean, this is just a consequence. But as an American citizen, you don't have to go down with Schiff just because you live here. You don't have to invest here. You can get your money invested in foreign markets. You can own gold, and you can gold mining stocks. Now, depending on what happens with taxes here, we'll see. I live in Puerto Rico. One of the main reasons I moved there is because I knew this was coming. I'm loaded up with gold stocks, and I knew I was going to have enormous capital gains. And I didn't want the government to confiscate those gains with a capital gains tax, so I moved to Puerto Rico where the capital gains tax is zero. Any other questions? I'm out of time.